Okay, let's start the stream. Morning, everyone. How are we all? Um, Dealing ranges and new day opening gaps. That's today. We'll look at the bias and then we'll go into new day opening gaps and then we'll use dealing ranges. Really nice and easy. It's not a really hard topic, so yeah. Okay, let's get some likes on the stream. Okay, bias. I'm looking at the range from September the 5th. We have this high from 9:30. That was NFP Friday. NFP came out at 8:30. It gave us a little bit of a spike, and then during the open, we just retraced like 50% of the weekly range. So yeah, that range that we've been working within since yesterday, since the start of the new week, we haven't gone up into the high or the low. So we've had an inside day yesterday, and today so far has been an inside day as well. So I'm looking at this as well, this is the dealing range technically. That's a dealing range. I'm not expecting us to drop all the way down to discount of the dealing range to go higher. We're already basically there. It looks like we've used support from Asia's balanced price range, which we'll go through in a bit. And my draw on liquidity now is to go up into the September the 5th daily high. That one. Yeah. Dropping down to a 5-minute. We've had some really choppy price action since London, but then the pre-market was really nice. We had a pre-market model set up. We literally just dropped down into the new day opening gap today, which is also the balanced price range for the Asia session. And then we've used that as a bouncing point. So I would like to either displace higher or for time distortion to occur until the 9:30 opening bell. If you're unfamiliar with time distortion is just when the algorithm delays price delivery. So instead of moving how it normally will, they'll just be held in consolidation until a point of significant volatility. So 9:30 opening bell. Usually we'll have some consolidation going into that, or news events like 8:30 or 10 a.m. news, or sometimes macros, but it's a little bit less common with macros. So yeah, my bias, I want to see us trade up into the September 5th high. The only thing I have working against me is that this is a classic sell day profile so far, but I'm pretty confident we can take London high, and then from there, this range isn't too big, some 15 handles, so we'll see how this, liquidity event, once we trade up into there, the London high, I want to see some form of, indication that we're going to keep trading higher into the September 5th daily high, whether that's with a breakaway gap or with, a short form S&T, short-term S&T. We'll see. And then from there, I don't really care too much what happens. The silver bullet setup is some kind of manipulation on the low and then trading up into that high. That would be the end of silver bullet. But we do have Asia low, which at this point in time is relatively equal lows. So if we go up to that high, on a normal, or maybe not normal, on a good day, after you take that daily high, it would be likely that you can trade down into this. But today's not a high probability day because we've got the CPI tomorrow. There's no high impact news today. The price action so far has been decent. Nothing crazy, but nothing super bad or anything. So yeah, you can probably get a good setup today. I'm going to take this off the chart now, and then we'll go into new day opening gaps first. Okay, we're going to go into new day opening gaps. So today's new day opening gap, where is it? As usual, the new day opening gap, if you're not aware, is the 6 o'clock or 6 p.m. opening price, and the 4:59 opening price. So what we're looking at here, I'm just going to zoom in a lot. This candle is 459. We're looking at the opening price of 459, like that. And then we're looking at the, did I say opening price? We're looking at the closing price of 459, and then we're looking at the opening price of 6 o'clock. Now, if you have a very small new day opening gap like this one's literally 2 ticks. Yeah, it's almost irrelevant. In that case, rather than using the normal standard new day opening gap, this is known as the actual new day opening gap, or the electronic trading hours new day opening gap. If you have a very insignificant one, where it's very small and is basically negligent in size, then in that case you can go and use the regular trading hours new day opening gap. The regular trading hours new day opening gap is the closing price at 414. So rather than using 459, you would use 414. Now, that's the closing price for the regular trading hours chart, and then you're using the opening price for the electronic trading hours chart. So this is 6 p.m. electronic trading hours opening price, new day opening gap. That is 414 closing price RTH chart. I realize that's a mouthful. You're not going to need to have all this annotation on your chart. I'm doing this so that, if someone joins, they can just read it and understand what it is. Like that. We'll do like this. See? So now, rather than using that little tiny new day opening gap, we're able to capitalize on this one, where it's a lot bigger in size. We can see that it's 5.75 handles, so that gives us more accurate readings. We did pick a good day to use it, because sometimes it'll trade really far away from them. So how do you use a new day opening gap? You want to align it with time, and you want to align it with your draw liquidity. So a new day opening gap is typically, although you can treat it as a PD array, it can sometimes act as a draw. Why? Because it is literally a gap in price. I mean, this one doesn't look like it, but if you're using the actual one, it's literally a gap. Yeah. And then we cut through candle. So just because that gap got filled in later on, you don't take it off your chart. You leave it on. You can have them for 5 days on your chart. That's a good base. Typically, 5 days is going to serve you the best. ICT explains all of this in 2024 mentorship, so you can check that out. Okay, we'll look at salient pools of liquidity, and then we'll get to dealing ranges. As always, we're going to be marking out pre-market high, pre-market low, Asia low. That's going to be a significant pool of liquidity. London high will also be a significant one. London high. And other than that, it's the September the 5th daily high that I'm looking at, so there we go. It's kind of annoying that it's in the way, but whatever. Okay, dealing ranges. Let's go to the 5-minute chart. got a few minutes until the open, so I might have to do it whilst the market is open. But there are multiple types of dealing ranges, like implied dealing ranges, unrealized dealing ranges. We're just going to focus on the standard dealing range. So a dealing range is from the low that takes out sell side until the high that takes out buy side. You can refine dealing ranges. We're not going to go into refined dealing ranges either, but if I take the indicator off, it'll look easier. This entire thing is our dealing range. We take out this low and we trade up into that high. It will always be the most recent external sell side and buy side, so you'll use this one and that one. You could also use that. That's still a dealing range. You could also use that. It takes out this high. You could also use that. So they're flexible. They're not completely rigid. All of them will serve you well. Say you're using a silver bullet. You want to be aligned with this like short-term one, and then you also want to keep in mind, you don't need to have it on your chart because it can be very annoying, but you want to keep in mind where you are relative to the underlying dealing range. I use dealing ranges a lot. I consider myself a specialist in them. But yeah, just the basics is you want to be buying in discount, you want to be selling in premium. So when you enter a premium, you're not looking for sells. You're only looking for sells in the discount. Now that's just a form of discount pricing. And in silver bullet, you never really want to be buying in equilibrium. The midpoint of the dealing range is equilibrium. You can also mark it out with quadrants, like that. So that's the quarter, that's the half, that's 3/4, and that's the full thing. Yeah. So if we're using the most recent dealing range, it's going to look like this. Like that. Anything below this grey box is going to be discount, and anything above that grey box in the red is going to be premium. So as a rule of thumb, you want to be aligning yourself with discount premium, only buying in discount, only selling in premium. If you're entering premium, you wouldn't be buying here, you would wait for it to trade back into discount. If that makes sense. If it doesn't, just let me know and I'll explain it. Yeah, so where's smart money going to be entering in the dealing range? It's going to be starting to accumulate their orders in the discount. So that's the dealing range. We trade up, we accumulate in the lower half, aka the discount, and then reacts off this order block, rallies higher into premium. So now smart money is going to be distributing their positions, and all that means is just closing their positions. If you're a specialist, in them, you're in good hands. Then I'm guessing in this lecture, yeah, you are. Amazing hands. How do I calculate a dealing range? I literally just went through it. The high that takes out a high, so you take out buy side liquidity. It can be as little as that, and you take out sell side liquidity, so it can be as little as that. Don't put too much emphasis on trying to get it perfect, because everyone has their own interpretation of a dealing range. You can use this, for example, as well. That would be fine. You can use... No, you wouldn't use that one. But yeah. Okay, we took out the pre-market high. Let's look at opening range gap. Here's yesterday's opening range gap. We could fill that in, potentially. So I'll be looking at this to fill it in. With opening range gaps, when you go into your regular trading hours chart, if you come to it the next day and you've still left that entire gap there, you can anticipate this being used as a draw on liquidity. Generally, you just want to use the last three, so today's one, yesterday's one, and the day before that. We filled in the day before yesterday, which was Friday. We haven't filled in yesterday's opening range gap, and then today we haven't filled in this one yet either. Not on the 15-minute chart. 4:14 closing price, 9:30 opening price. So just touched off that busy. Okay, any questions so far? 38 people, 14 likes. What's going on? Leave some likes, boost the channel, boost the algorithm. Oh well. Okay, so I assume everyone understands the opening gaps and dealing ranges now, like how to draw them on. I'll do more on using them and utilizing them in the silver bullet trades as we go through the tape reading lecture today. Yeah. Back into the 9:30 order block. Oh yeah, there's 2 1-minute shots. Whoops. So this range, Asia low, London high, you can use that as a dealing range. Okay. I realize how messy it looks, but yeah. I trade US 100, so I don't have that range. Okay, yeah, you're only going to get it on futures charts. You won't get it on the cash option. It's fine if you don't. US 100 is still algorithmic. You won't have access to things like opening ranges, but it's fine. You can either refer to like the actual futures chart or just completely omit that part of your analysis. And you don't need this, but it is nice. Okay, we've taken out a pre-market high. That is London City, which is reacted to. Okay, so your regular trading guy, when you do opening gap high, it's going to overlap with your opening range gap 414 opening price because they use the same prices. So you have to clean up your charts, you can just take that off. Easy. Okay, I don't like that it rejected from here. Now I want to see it trade above that because I'm bullish. I want to see bullish prices. But if it can take out a low first, even better. If it can come all the way down here and then use that as optimal trade entry from the underlying dealing range, and then trade into the daily high, that would be really, really nice, really ideal, and a really easy silver bullet trade. On MNQ, it doesn't look like it took the high. MNQ. Oh yes, equal highs on MNQ. Thing is, NQ is the main one. NQ is the leader, so it happened on NQ. It pretty much happened on MNQ. It's just, yeah, sometimes it's not going to be as accurate because MNQ is just a copy of NQ. So you place more emphasis on what happened on NQ rather than MNQ. But it's rare that it makes a difference in your analysis. Okay, even taking out this low is enough of a manipulation to start looking for higher prices or an SMT. So you know how I always say when it manipulates, then you're looking for the what do you call it? You're looking for the market structure shift. And SMT is enough of that, and so is just this low, that low. It doesn't need to go and take the pre-market low. It doesn't need to take out some major low. It can be internal range. So this is internal range liquidity. You could easily just take that out and it's fine. 15-minute chart. Pretty much the same story. Did just miss this gap. So this is a breakaway gap. How do you calculate when to consider the wicks or the bodies or the point of liquidity? The point of liquidity is always going to be the wicks. When you're looking at relatively equal highs, that's when you can be a little bit more flexible with the wicks. So rather than looking strictly at, if I can find an example. Okay, so this, even though they're relatively equal highs, the high on the right is slightly above the high on the left. With relatively equal highs, you can be more flexible. However, it is higher probability if the one on the left is higher than the one on the right. But it's still valid if it's like that. It's just better to be like that. Okay, cool. So the new day opening gap during the pre-market hours from 7 o'clock to 9:30. Typically, you'll break through some kind of manipulation, or you'll manipulate a high or a low, and then you'll trade into it, which is what happened there. We manipulated this high, and did we manipulate that one too? No, we made equal highs there. But we did manipulate this high, turtle soup, and then you could have traded that low. Now this isn't a great trade. I wouldn't have taken that because how choppy it was. But it still is a trade. So you'll see that the new day opening gap is used as an area of support or an area of resistance quite a lot, where in certain hours of the day, like 7 o'clock to 9:30, or during Asia. In Asia, it happens a lot, especially from 7 o'clock onwards. It's part of the ATM model, where you want to build up liquidity going into the 7 o'clock hour by accumulating away from the opening gap and then returning into it between the hours of 7 and 9 o'clock. So 7 o'clock, 7:50 drops in. Really easy ATM model there. Quite weird, the price action here. Lots of wicks. You want to avoid this. You don't want to be in that. Your breakaway gap, you ideally want this to be in the 20 to 30% of the range. So in this dealing range, if I take my fib from the low to the high, and I'm looking at the 0.2, 0.3. Alright, that's 20 to 30% of the dealing range. The best breakaway gaps are going to form within that. This line is 20%, this line is 30% of the entire dealing range. You can expect the breakaway gaps to form there, within that. If it forms away from it, you're probably looking at maybe, I'm not saying the wrong range, but you're probably targeting something higher than where you've projected your high. So say this one, for example. And you can use that to project a new range. So if you're looking at a dealing range like that, this is kind of advanced, and your breakaway gap forms there. Obviously you want your breakaway gaps to form between 20 and 30%, so you would take the fib until it aligns with that breakaway gap, so like that. You see how that aligns with our London high? The fib goes up to there now. That'll be it. That isn't a breakaway gap though anymore, so. Nice, we took out this low. Like I just said, taking that low is enough of the manipulation. Wait, is the stream still going? It says the chat's been disconnected. That's weird. Okay, let's take a look at midnight opening price. Midnight opening price. Okay, what's up, Switchy-san? Don't you think that low resistance liquidity got done with and now it's got to go lower? No, I want the daily high. Okay, is the stream back? I think my internet dropped for a minute. I don't know why. Weird. Oh yeah. Okay, it's back. Okay, good. Sorry. Weird internet. Velvet, can you please look at the trade I took? I posted it in trading chat. I took the L. Yeah, I'll do it after the stream's done. 937. First presented fair value gap. 937. No, there's no first presented fair value gap. There's no fair value gap at all. It's just wicks. Yeah, we don't need to be telling people that. It's nice to see you back here, Switchy-san, as well. There's a 6-second delay. Oh shit. You might just have to refresh your YouTube page. Yeah, sorry about that. Okay, so in this case, we're not using a market structure shift. You're using change in state of delivery because, well, this is really messy. It's not clean at all, so you don't have a clean market structure shift. But you can use a change state of delivery there because it's far enough from the manipulation that you can use it. So, change state of delivery. You wouldn't use one like this. You wouldn't use that because of how close it is to the manipulation leg. Reacting off the 6 a.m. first presented fair value gap. Oh yeah. I don't want to make it too complicated. Still an expert in the change state delivery. Yeah. I think it was 2 days ago we did advanced market structure, I think, and I was going through that. Or it was yesterday. I don't even remember. Okay, so this is accumulation above an old high. It's a bull flag. It gave the fake signal higher with these two candles and dropped, stops them out, manipulation, and then it's traded higher now. I really like that in terms of drawing towards higher prices, but I need to see some kind of good displacement here before entering. this is why it's really nice to have midnight opening price marked out, because you can get a good gauge in where price is going to gyrate. What does it mean when they say wicks are gaps? Can I use them exactly the same, or is there a specific way they'll use it as different? With wicks, you're not really using them as gaps. I get that for some reason people like to call them gaps because ICT calls them gaps. Personally, I just think a wick is a wick. It is a PD array, but it's more about the key levels inside of it. Like the 0.5 level, and on a big wick, the 0.25 and the 0.75 level are really, really good. Yeah, you shouldn't treat them like fair value gaps or anything. A wick is just a wick, but it can still be used, yeah. Okay, we're coming into the macro now. Yeah, really nice displacement. We put this order block in. We're traded above that high. There wasn't a fair value gap here, but it's fine. So that's some formal market structure shift. And that's a very good order block. Waiting for the macro. Well, that's a weird reaction. Let's look at ES. It's not completely out of correlation. There is an SMT at the lows. There. YM's also got an SMT, but this isn't really correlated, so. Probably not going to be the cleanest setups today. The second half of the week is going to be where we have the main amount of setups, like some really good ones, because we've got CPI tomorrow, and then Thursday's got high impact news, and then Friday's got high impact news. So the rest of the week should be amazing. Okay, macro has begun. I really didn't like that change step delivery. But it has engineered some good liquidity at the highs. Grey pools. Nah, you're not using grey pools in here because it's so wicky that the entire thing would be a grey pool. Oh, maybe you mean this one? This one, yeah. Yeah, this swing point, or these ones, because I would never use these ones, but this is fine. So those look really tasty. Yeah, I guess they do. I'm annoyed, price is too choppy. There's no need to get annoyed. Just don't take a trade. I know this isn't part of the lecture, but if there was a body SMT, would you use that or the wick SMT? Use the wicks. You don't use the bodies. Because it's about where price created a higher high or lower low. It's not to do with just where the bodies are positioned. So a wick trading through a high is a higher high. Just if the body closes above it or below it, it's kind of irrelevant. Because if the wick traded through it, that's, you know, that's fine. Don't take a trade, says the guy with the fridge that distributes ice and has a... I don't have a Lambo. Stop spreading rumors. Okay, that's your first presented fair value gap at 950. Took a while to form, but it has formed. Done. 906 order block. Yeah. I wouldn't really look at the order block, though. I would look at the lows. Or the NDOG. But that's just me. 942 first presented fair value gap. There's no gap there. If you mean this little tiny thing, nah, you will never use the gap like that. I know technically that's the first inefficient price delivery, but you disqualify it literally just because it's tiny. You will never use that in your real trading. So when it comes to first presented fair value gaps, you still just don't use that. So every principle that you apply to fair value gaps normally, you just apply to this one. So when it's first presented fair value gaps, you're not looking at anything that's really small like that. You're looking at something that breaks away from the range. Institutional volume is in the bodies. Yeah, macro. Isn't it funny? The minute we hit the macro, the volume comes in. Yeah, I would like this inverted, but I mean, this is already enough of a low that if it trades above the first presented fair value gap, it's nice. We don't need to take this low out. The only time it's not a presented fair value gap is when it's a BPR. Yeah, so a bounce price range to the left of it. If it becomes a bounce price range after you draw it out, like price gives you displacement through that now, and it creates a BPR, it would still be the first presented fair value gap. But if there's anything to the left on it, that signifies it's a bounce price range to the immediate left, like this, not this, but this, then you would consider a bounce price range. Don't you think that low resistance liquidity got done with and now it's going to go lower? I mean, potentially, but I think the overall draw today should be the daily high. We could manipulate Asia low, but following an inside day, you always want to look for the daily high and the daily low. But you know, in this case, we fell short of it. And you wait for manipulation on one side and then go to the other. But you know, I could be wrong. It's a new day opening gap. Some people really don't like to use the regular trading hours new day opening gap. Don't know why, because it works still amazingly well. I get that it's not like a physical gap on the chart, but it is still a gap between the regular trading hours chart and the electronic trading hours chart. So I'm going to be looking bullish only. Yeah, I want to see something that implies that we're going to go up into the daily high from, I should say September the 5th. So inverting this presented fair value gap, putting a high in, trading above that high, trading into another fair value gap, that would be really nice, especially since we are in discount. So this is discount, but we'll see. Okay, stacking the opening prices. So if you look at This here is the 8:30 opening price. 8:30 open. And then you also have the midnight opening price. When you're below both of those, you're in a deep discount, and when you're above both of those, you're in a deep premium. So if you're looking at your dealing range, and you're in the discount your dealing range, and you're in the discount because you're below midnight open and below 8:30 open, and you have an underlying bullish narrative, then you can get really good pricing for longs. Below midnight opening price and 8:30 opening price, that's where smart money's going to be buying. In between these, it's a bit iffy. But if you're on one side completely and you have a bullish narrative, obviously your narrative has to be correct. But if you have that bullish narrative, then it's a really good place to buy, really good pricing to get in at. Can the 8 to 8:30 presented fair value gap be the 8:30 candle, or only 8:31 onwards like market open? 8 to 8:30 be the 8:30 candle, or only 9:31 onwards? Do you mean 8:30 to 9 o'clock? Or do you mean 8 to 9:30? Dance. Now I don't know because it's changed to delivery, not market structure shift. Okay. CISD is change in state of delivery. How do you identify protected highs or lows? Okay. Let's, I'll draw it out. There's a lot of ways. You need to have familiarity with a lot of different concepts to be able to identify all of them in price. Like, I can look at any high and low and say, oh, that's a protected high, that's not a protected high, whatever. A common one will be that. When you have a PD array, maybe an SMT. An SMT, if it's valid, if it's below midnight opening price and 8:30 opening price, that's a great way to tell if it's valid. If you have a bullish narrative, say that's an SMT. SMT with yes, for example. That would become a protected low because in NASDAQ, there was a stop hunt, and then there was a stop hunt again. It reacted off a PD array plus the SMT. That's a protected low. Now, a protected low isn't just stacking confluences, but an SMT creates a protected low. An intermediate term low is also a form of protected low if you're bullish. Same with a long term low. So if that's like that, and we're just looking at market structure, and that's an intermediate term low, and that's an intermediate term low. This should be and that becomes a long-term low. A long-term low is always going to be protected, so is a long-term high. If you're bullish and you have a long-term low, you're not looking for the long-term low to get tail souped, because this should be the tail soup below that intermediate term low, and then after that, this is the protected low. I probably just confused you even more there, but sorry, I meant 8 a.m. or 8:01 for the hour. Could be the first percent of fair value gap, beat the 8 candle, I mean 8:01 onwards. Well, as T's never explicitly said, it has to be 8:01 onwards, but I would assume the principle still applies where you're looking at 8:01 onwards. But to be honest, I don't actually have the answer to that. Sorry. Typically, I do use 8:01, but I've never backtested anything different, so. How would I know how to enter a fair value gap? Like if I entered the first presented fair value gap on the first entry, I would have got taken out. Well, the conditions right now aren't right to be trading, but you have to have a strong narrative. So if you have relatively equal highs, you trade above the first presented fair value gap, like you invert it and then you trade back into it, that would be a good entry. especially if it's aligned with something like this. I feel like ordinarily this would play out, but today's market's just a bit weird. I don't know. These are the conditions where if you're trading in, you can really mess up your equity. You don't, the second you see this, wick, and then you distribute. But then it's like against what you're expecting to see. Sit on your hands, wait, let them do what they're going to do. We just traded below the Asia low. What's this zero thing? Well, that's yesterday's opening range gap. But yeah, you want to sit on your hands and chill. Let them do what they're going to do and wait for everything that I've been teaching in this mentorship. So the liquidity event, when you sweep liquidity, what are you waiting for? Some kind of bullish market structure. You're waiting for all those triggers that you're looking for. Your narrative, they all need to align. If you have a first presented fair value gap, say it was down there, for example, you invert this, you get a change state of delivery, a market structure shift, you're reacting with a breaker block, whatever. That's enough narrative to then be confident in taking a long or a short or whatever. Does any changes state of delivery work if there is equal highs? No. You still have to have narrative behind it. There's always going to be equal highs and lows on both sides of the marketplace. You have to be able to identify where it's going to go. So just having equal highs isn't enough to say we're bullish, because there are going to be so many situations where there's equal highs and you can just frame it and say, oh, I'm bullish or I'm bearish or whatever. So narrative is king. Narrative is why price is going to move. If you know why it's going to move, where it's going to move to, who's going to be harmed, who's going to be getting in, those are all the things that you need to be asking yourself when you're thinking, why did it drop into Asia low? Who's it tricking into a trade? Is retail being tricked in? Are institutions buying now? Are they waiting? What's going on? So that level of reasoning, you only get that through time and through sitting through the ICT rounds, which I know a lot of you don't like to do, but you do have to do it, to be honest. So if that implied fair value gap gets inversed, would you trade high? I don't really use implied fair value gaps, to be honest. I don't like them. If you're sorry, you need to be sorry. The last first presented fair value gap question. If 803 busy today is the first presented fair value gap for the 8 hour, is it invalid because the AM still on the left made a BPR? Okay. 803. I see what you mean. The thing is, it's just changed from a first presented fair value gap into a first presented bounce price range. You can have first presented of any PDRA really. It's just fair value gaps are like the popular one because it's really easy to see. So it wouldn't be a first presented fair value gap. It would be a first presented bounce price range, but they have similarities in how you treat them, in how they behave in price action, that you could still treat it as a fair value gap and get away with it. It doesn't make a huge difference. I recommend you watch ICT's video on disqualifying first presented fair value gaps. That should help. Get rid of that one. No problem. It's probably random. Regular trading hours, the opening gap high. And people think these ones are weaker than the other ones. They're not, they're the exact same. Whether it's regular trading hours new day opening gap or the electronic trading hours new day opening gap, it'll still serve you very well. So this here is the opening range gap from September the 8th. And as you can see, we reacted to the high of it and left it. We've taken out these relatively equal lows on the regular trading hours chart, which on the electronic trading hours chart is our Asia low. We'll see that turn into an order block. If there's a fair value gap here, it's real nice. And then I think that's enough support, as long as this creates a fair value gap, to be looking at September 5th daily high. That's not a buy signal. Going along now. Please don't tell me that. I don't need to know. You can tell me in Discord. But, if I say, oh, it's a good entry, and then people are saying, oh, I'm going long, then it doesn't annoy me that much, but I don't want to be responsible for anyone's losses. So just keep it to yourself, please. If you could. 40 people, 24 likes. Let's get those likes up. It's free. The stream is free. The mentorship is free. The Discord's free. The analysis is free. The reviews are free. The weekly outlook's free. Just like the stream. Okay, that'll be nice to reclaim. Millionaire's asking for free likes. I'm not a millionaire, bro. I'm not a millionaire. But it does help my channel. I get more views and stuff. And I want views. I want to be famous. Joking. But I do want to grow in the trading community. What is a perfect market structure shift according to the situation? There is no perfect market structure shift ever, but I wouldn't use that because it's too far away from the liquidity event. So wherever that liquidity pool is, you want something near to that. So this isn't a market structure shift because it's not a swing point. The nearest swing point is up there, but that's 43 handles away. So I wouldn't use that. I would use a change of state of delivery in that case. Trading above the order block is enough. Okay, this is really good price delivery. I like that it's displacing. I like that it left this breakaway gap. Better than the paid mentorship I tried, thank you. You're welcome, Chris. You're very welcome. Can you repeat your reason for bullish? I did because of the implied for value conversion. Just give me a minute. Bro has an ice machine at home. It's not an ice machine, it's the fridge. It gives ice because there's like a button. Click the button, ice appears. And it's also a filtered water system, so you just hold it down and water comes out. I'm studying trading to buy ice making machine. I have 0 Lambos. If you want to buy me a Lambo, feel free. I know there's someone here that's rich. Yeah, someone's got to be rich. I have a fridge that's shorter than me. Yeah, but I'm not that tall. I'm a short king. Okay, so trading. So yeah, your name's trading. The reason I was bullish, we had an inside day yesterday. I wouldn't expect an inside day to be followed up by another inside day. We do have no news today and CPI tomorrow, so that expectation you would normally want to take with some flexibility. You don't want to like be thinking, oh, it has to take the previous day high, it has to take the previous day low. You want to have some flexibility with that. However, in this case, where we were held in such a tight consolidation yesterday, after a large range day, so yesterday was a low probability day. It wasn't huge in terms of size or volatility, but it was nice in the engineering of the highs. So yeah, and then the rest, I think I might have said in Discord. I can't remember. I've got the memory of a goldfish. Smart money knows about ICT, that's why it didn't make perfect market structure shift on downside. That's nothing to do with it. Just because people trade ICT doesn't mean it gets worse. The market just operates how it operates. Whatever people do doesn't matter. Does this candle logic work on the hourly candles? Yeah, it works on every chart. Every chart. I don't even have. Yeah. Okay, so remember our definition of bullish order flow. Down close candles should support up close candles. So now we've got two down close candles. Ideally, we want to see this be used as support, so we want to trade above that, and then use it as a bullish order block, and then take off. Best case is at the open, but ideally no less than the mean threshold. If it's three down close candles, it's still fine. If it's four, it's still fine. But when you trade above it, then that's when you have to, react and use it as support. Ideally. Okay. Who remembers what I said about breakaway gaps? Oh, 902. 902. Is our low? That's our September the 5th daily high. You can check that level if you want. And this is our breakaway gap. And it formed where? 20 to 30% of the implied dealing range. So that reinforces the idea that you're probably likely to trade into the implied dealing range's terminus point. Getting back into the first percentage of value gap. So that's this busy here. It shouldn't return to this breakaway gap if it's actually bullish. I'm thinking for long from the first percent of value gap. Okay. Ideally. So to be clear, if I find an inside candle on the 1 hour, I can expect either of the extremes to be taken out. Would you suggest refining it on the low time frame, the sort of equal highs and such? Yeah, so if you have an inside candle on any time frame, the next candle is more likely, not necessarily, 100%, but it's more likely to take out the previous day high or low. That's because A, that inside candle is a form of accumulation. You should manipulate one side. And B, it's consolidating. It's a smaller, tighter range, so it's easier for price to trade up into the high of that or the low of that. If that makes sense. Okay, these are the situations where you want to look for an SMT. So no SMT with ES, no SMT with YM. Was it on my drawings? Go? That's so annoying. Trading view sucks. MT4's better than this. Not ideal. I wouldn't have wanted it to close outside of the first percent of fair value gap at all. So, given the conditions, I would have trouble trusting this to play out. $2022 model here. A silver bullet is a 2022 model. It's just time-based. Okay, return it to the breakaway gap. We'll see if it keeps it as a breakaway gap. It did react to the consequent encroachment, which is quite nice. Last time I asked you and you said the stop loss should be below the breakaway gap. Yeah. That is correct. That's all I like to do. Okay, by the way, this is the new leading range now. From this low up to this high. So here we take our buy side. That means it's no longer valid to use this. I know I said they're flexible, but you still have to use the valid ones. So you wouldn't use this anymore because buy side was taken out. So then you switch it to buy side, and then sell side's taken out. So you switch it to sell side. So that would be your new dealing range. And yes, this is very confusing to look at. Because there's so much on the chart, but we just have to gloss over it. I don't know what any of that means. If you don't know what it means, don't worry about it. Yeah, don't worry about it. Just tell me how to get around with the You tell me. I don't know. I just trade, bro. I don't know anything about girls. Seek and destroy? Yeah, seek and destroy. Just tell me how to get them. Oh, read that one. Didn't buy side get taken again. Ah, that's the most recent one. I'm on long. Hope profit find me. Oh, hope profit find me. What's your opinion? Yeah, I don't approve your. Yeah, I don't say, oh, that's a good trade, that's a bad trade for your trades. I don't say for my trades. So. That's still a breakaway gap, by the way, because it didn't trade past consequent encroachment. So it's pretty good. Okay, so there were no up close candles through this. Oh, we did trade below that one. Bit annoying. Not the cleanest. I was gonna say there's no up close candles through that, so as long as we trade above it, we can still see this area use as support. But we did trade below that one. It's not high probability conditions. Don't be risking a lot or anything. Just chill a bit, calm down, sit on your hands, and wait for the good days. It may be hard sitting through an hour and a half of just gobbledygook, but you just have to do it. There's no shortcuts. If you want to be a trader, your whole job will be sitting through stuff like this and not taking a trade. Because you could be risking money with a click of a button. You can just do this and then click those buttons, and there's money on the line. So yeah, being a trader is dangerous. You have to be disciplined. Don't get into positions prematurely. Don't chase price. Don't think you're seeing things that you're not seeing. Yeah. If you want to look at optimal trade entry, dealing ranges, you can apply optimal trade entry. So just about touch the 618 level or the 62 level, depending on what you use. So that is an optimal trade entry. Once you're up there, I wouldn't have expected it to drop all the way down into 618, but it's still valid. Well, after it violates the breakaway gap, it hasn't violated the breakaway gap. But if it does violate the breakaway gap, then you would, I'm not saying you flip your bias, but you have to like double check yourself. Did you get it wrong? Or did you identify the breakaway gap wrong? Is it just a low probability condition where it's probably going to be highlighting outside the lines? Like today's a very low probability condition. This is seek and destroy where it just whips back and forth, back and forth, back and forth, back and forth. On a good high probability day, like tomorrow, Thursday and Friday, not every Wednesday, Thursday and Friday, but this week specifically, the high probability days are going to be in the second half of the week, Wednesday, Thursday and Friday, because that's when the news events are. On those days, then you can demand more out of the market. So you can say, I don't want it to return to the breakaway gap at all, and then take a trade. On a day like today, you have to expect things like that to happen, where we get terrible price, we whip back and forth, we get time distortion, you know. That's technically news candle. They keep missing my short TP limit orders by a hair. That's unfortunate. As soon as I impulse buy or sell, I feel terrible and close it anyways. Yeah, that's the better thing to do. Like, it's better to close it instantly if you realize you're in a bad position. If it looks to you that it's become invalid, or if it just, you're going to feel uncomfortable in positions. Everyone has to go through that. But if you're, in particular, like, you realize that you're wrong, then yeah, take it off. Will I be doing advanced gap theory? No. No. I don't want to. I have too many other things in front of the line. Pre-market model, classic buy or sell day, daily profiles, market maker models. I have another pre-market model as well. Asian ATM model. I have a little bit of a twist to my Asian ATM model, which works pretty well. And then to do advanced gap theory in between all of that, which would need a few more videos. I don't think I could fit that into one lecture. Yeah, I wouldn't bother. In the future, yes, but like right now, no. Just to clarify, we don't trade the news, but the news is good for increased volume / volatility. Yeah, it's not even just the volume. The volume's a big part of it, yeah, but it's more about the algorithm. So when you're in the lead up to a news event, sometimes it's going to be held in consolidation, and it's gonna wait for that 8:30 event. It'll have a little bit of time distortion, and then at 8:30, it'll start spooling because of news. Even when there's no news, the algorithm's going to turn on then, and that's when it's going to be spooling. But in particular, when there's news, those are the times where you really want to be using the 8:30 opening price, for example, as well. But it also allows them to have an excuse to manipulate one side of the market, and then it's almost as if the sentiment after a news event becomes really obvious. So when you get a really large candle that goes one way, it's really easy with the data you get after that in the next half an hour to predict where people are going to be on the market. So what's the open interest? Are people going to be more in sells or buys? Where from? How can that be used? Blah, blah, blah. So when there's news events, it is higher probability. It's really easy to read the narrative. Whereas when it's a day like today, look at this. From 9:31 until 9:50, that was horrid. And this is the time it's going to be hard in the build up to the macro. But then even after the macro, it wasn't that great. Hasn't the swing above the breakaway gap become a bounce price range? Which one? This one? Well, technically yes, but I'm only in this mentorship going to be using the bounce price range where it's two overlapping inefficiencies. If I can find one like that. I will teach bounce price ranges in depth at some point. But right now, just consider it two overlapping inefficiencies. What model would you recommend? Silver bullet. That's why we're doing the silver bullet. Can you share your list on Discord? List of what? Sunday. See you soon. Oh, 1 second, guys. Be back in like 20 seconds. Okay, back. Yeah, see you Sunday. See you tomorrow. Prediction, the 30-minute candle will be a death maul. Oh, a Darth Maul? I don't know what a Darth Maul is. Like the 30-minute chart. List of the topics / videos you plan on doing. Well, I like to be flexible, so I have, 30 in my head, but then I'll do like 4, and then I'll put them on the sidelines, and I'll say, I want to do this one, and I'll do that one, and then, so I'm a bit all over the place. I don't really want to be giving out a list, and then giving you a false expectation of what to expect from my videos, so I think I probably won't do that. Equal and along whips like Darth Maul Saber. Yeah, I haven't watched Star Wars. I've never watched Star Wars. Yeah. And that really flipped. Took that high and then left. I would have thought it would go into the daily high, which has also been removed from the chart. That one. Okay, that's an inversion gap now. But you can see how, even though my bias was wrong, the new day opening gaps, these act as support and resistance levels. So rather than using, the classic support and resistance, which is like, oh, it's going to resist off that line, random stuff, you can use new day opening gaps in place of that, and new week opening gaps. if I go into a different chart, I'll show you now. So this is a layout where I pretty much just keep new day opening gaps and new week opening gaps that I find extremely relevant. And you can see how price uses them as support and resistance levels. It constantly reacts to them. It constantly refers to them, like that. Look at that, look at that. Look at this one. This one's from 29th of August. It was used as resistance to go lower. It was used there for support. It was used there for support. PM for support. And today, I guess we're reaching into it now. So you always want to have at least 5 new day opening gaps in the chart. And you can use them as reference points. You're not looking at them super strict, oh, it has to go here, it has to go there. But you do want to have them in mind for price delivery. Because I guess now it is trading into that August 28th new day opening gap. And then your dealing range now is that low. It just took out the sell side. Market maker sell model. Yeah. Managed to get out my short, nice. That is nice. Well done. Let's just check that new day opening gap level. 23,762 and 23,760. That's the August 28th new day opening gap. I think we might end stream in a few minutes. Yeah, okay, we've reached that. My draw today was the... Has it disappeared again? Disappeared again. Okay, it was that high, and we didn't get it, unfortunately. I really like that level as well, but it's okay. Sometimes I get it wrong. But yeah, that's the stream. I'm pretty sure I've said everything I needed to say on dealing ranges and new day opening gaps. Tomorrow, I need to plan out tomorrow's one. I'm not sure what tomorrow's stream is going to be. I'll figure it out. But I'm going to go in Discord now, reply to a few students, then I'm going to go eat, and then I'll be back for PM session, not for a live stream, but for Discord. So hopefully you're coming away with something, hopefully you've learned something. Thank you for watching. Goodbye.